Good day, everyone. I'm Michael Chang, Chief Investment Officer Fixed Income at RHB Asset Management. Thank you once again for listening to this podcast. Last month, there was a surge in virus infections sweeping Asia. The speed of transmission has been fastest in India, where infections have been rising much more rapidly in the first wave. India saw 3.9 million cases in the first 10 days of May alone. Japan, Malaysia, and Thailand have also experienced rapid increases. Even Singapore, Taiwan, and Vietnam, where they are among the most successful in controlling COVID-19, have seen a jump in infections as of 24th May 2021. For Asia, to contain this COVID-19 resurgence, the only way is to ramp up vaccination rates in the respective countries. We have seen this success in the advanced economies, in particular in the US, the UK, and Europe. On vaccination, Malaysia surpassed the 200,000 level of vaccine doses administered for the first time on 15 June 2021, where more than 215,000 doses delivered to Malaysians. Growth picked up across much of Asia in first quarter of 2021. China's GDP expanded 18.3% year-on-year, largely reflecting a low base of comparison in early 2020, where the country was first hit by the COVID-19 pandemic. South Korea, Singapore, and Australia pulled out of contractions in the final quarter of 2020 to register growth in first quarter of 2021. In weaker shape, Malaysia, Indonesia, Japan, Thailand, and Philippines still recorded contractions in their economies, though narrower ones in the fourth quarter of 2020. I will dive a bit deeper on global inflation since this has been a hot topic for everyone. Under economic measures, it has core inflation rising to its highest since 1992. This is consistent with the rise in producer price inflation. That explains why darker blue readings as they are above the normal mean. On market indicators, 5-year break-even rate topped 2.75%, virtually matching their high during the 2008 oil spike, but that has now receded to below 2.5% as bond yields trended lower. This means from a bond market standpoint, they perceive that the US Fed still thinks inflation is under control. To add, Germany or Japan has yet to snap out of their disinflationary malaise. Wage inflation is a crucial driver of inflation, but at the moment, there's little risk of wage inflation as most measures of wages are still running below their average for the last decade. Lastly, on expert forecasts, most CPI readings by economists still expect inflation to hover around the average levels. Even China also has mild expectations on inflation. Drilling into these indicators, in summary, the concern of global inflation is likely to be transitory in nature and in line with consensus. On domestic inflation, Malaysia's inflation is poised to pick up in Q2 2021, tracking the return to 2019 levels in oil prices after 2020's slump due to the pandemic. As oil prices plunged last year, so did Malaysia's inflation levels, which was negative between March 2020 and January 2021. Deflation was deepest at 2.9% year-on-year in April and May last year consecutively. Therefore, these are the months this year where Malaysia's inflation should be strongest due to base effects. We should see a softening in inflation for the rest of the year. The central bank also expects underlying inflation to remain subdued this year due to ongoing spare capacity. The ongoing spare capacity will likely prolong given the current lockdown. In conclusion, on the domestic bond market, while Malaysia Government Securities MGS yields retraced lower earlier arising from the FTSE Russell's World Government Bond Index announcement end March 2021, we saw US Treasury 10-year yield adjusted much lower by 30 basis points in June 2021, where it went below a yield of 1.5% since March this year. MGS yield comparatively was flat. Once again, with this development, 10-year spread between US and Malaysia has turned attractive, with the latest creeping up to 180 basis points again, a level last seen in March, a bit driven by lower US Treasury yields. We hope this podcast has been useful to you, and we would like to thank you for listening.